Today I want to share with you 5 tips that you can use to lower your tax bill for 2020 and put more money back into your pocket. Let's do this. Hi, my name is Jim Hart. I'm the founding attorney here at Hawthorn Law, where we help online businesses to get your legal house in order so that you can focus on what you do best, and that is building a business that truly matters in the world. If you are running an online business as a coach, a consultant, a course creator, or even just a social media influencer, then you are probably looking for that time freedom, location freedom, and ultimately the financial freedom that we all want as online entrepreneurs. Today, I want to focus on getting you more of the financial freedom by legally spending less money on your taxes and putting more money in your pocket. Now, the problem for many of you is that the tax code is complicated and it's constantly changing. There are many deductions that you could have taken several years ago that are no longer allowed today. But as a result, there now are a number of deductions that you can take that weren't available until just recently. And you might think that these deductions aren't going to save you that much money, but honestly, you'd be very wrong about that. Some of these deductions could literally save you thousands, if not tens of thousands of dollars. Every year about this time, I start looking into all the various strategies that I can use to keep my tax bill as low as possible. And this year, I found 5 major strategies that you're probably going to want to hear about and learn more about to save money on your taxes. So without further ado, let's get into those top 5 strategies that you can use to keep your 2020 tax bill as low as possible. Now, before I get into this, I do want to give you a heads up that many of these strategies must be implemented before the clock strikes midnight on December 31st, 2020. So if you wait until January, or if you're watching this video in January, then unfortunately you're going to lose out on these benefits. So act fast. Also, make sure you talk to your accountant or bookkeeper if you have questions about any of these strategies and how they might apply to you and your business. I'm a lawyer and I do a lot with taxes, but I'm not your lawyer and I'm not your tax strategy person, so you definitely want to talk to a professional if you have questions. Let's get into this. The first strategy I want to tell you about is to use your sick days. And you might be wondering, what in the world do I mean by that? Well, this is a special strategy that you can use if you're self-employed, if you've got an LLC, if you have an S corporation or a C corporation, and it's because of the coronavirus pandemic and the relief bill that was first passed into law way back when, in March, I think, sometime of this year. So what I mean by this, if you're self-employed, you can claim up to $5,110, that's $511 per day in emergency sick leave to care for yourself, or $2,000 up to $200 per day to care for a family member. This isn't something where you're going to get this money directly from the government like the stimulus checks were, but what's going to happen here is this is actually a credit that is applied to your employer's Social Security and Medicare taxes. Now, if you're keeping track, if you're self-employed, you are the employer, which means that when you pay yourself payroll, you're going to pay a portion of that is going to be your obligation as the employee, and a portion of that payroll is going to be what's going to be paid as the employer. So this is a credit that's going to go towards the amount that you as the employer will be paying towards these Social Security and Medicare taxes. And if you're wondering, well, what if I didn't pay that much in Social Security and Medicare taxes? That's okay. Because it will roll over and apply as a credit towards future taxes that you may owe. In addition, you can claim an additional $10,000 in emergency family medical leave at a rate of $200 per day. Now again, this amount will be credited towards your Social Security and Medicare taxes that are paid by your employer, which is you. And if you haven't paid at least $10,000 in employer taxes for Social Security and Medicare, then it would be credited towards your future bills. Now, if you're working with a payroll servicer, they can walk you through exactly what you need to do to take advantage of these credits. And if you're taxed as a disregarded entity, then I highly recommend that you talk to your accountant or your bookkeeper, because you're probably not going to have a payroll provider in your situation. I do have a link down below to the payroll provider that I use. It's currently Gusto. I love them. There's a link down below. It is an affiliate link, which means I'm going to earn a slight commission if you sign up through that link. I believe after you run your first payroll, you do get a gift card from Amazon, so check that out. The second strategy I have for you is to plan your payroll to maximize your retirement contributions. Now, what do I mean by this? If you're self-employed, there are two main retirement plans that you're going to want to look into, and these are the Solo 401k and the SEP IRA. These are the two plans that are going to allow you to sock away the most amount of money each year for retirement if you're self-employed. The main difference between the two is the number of employees that you can have if you choose to use that plan. So, for example, if you have employees, then you must go with the SEP IRA. And the reason for this is you have to contribute the same amount to your employers, and on a percentage basis, you have to contribute the same amount to your employees' accounts as you do to your account. But if you do not have employees other than your spouse, then the Solo 401k is definitely going to be the better option. Now, for a Solo 401k, you can contribute up to $57,000 in 2020 with a catch-up contribution of an additional $6,500 if you're over the age of 50. For a SEP IRA, you can contribute up to $57,000 for 2020, but there is no catch-up contribution because all the contributions from a SEP IRA are contributed by you as the employer as opposed to you as the employee. All right, number 3 is something I talk about every year when I do this video, and that's to prepay your expenses for 2021. This is honestly fairly self-explanatory. If you have extra cash lying around after you've planned for your last payroll and your retirement contributions and you've maxed all that out, then the next thing you definitely want to look into doing is prepaying your expenses for next year, or even purchasing new or upgraded equipment for your office. This could be new computers, new telephones, get a new cell phone, things like that that you're going to use for the business. So for example, if you were thinking about starting a YouTube channel and you need a new camera, now might be the time to invest before the clock strikes midnight on December 31st. Get that camera now and you can write it off on this year's taxes. Or you could just prepay things like your rent, your utilities, or invest in the annual plan for some of your computer software. So for example, if you've got a software as a service that charges $200 a month, but they'll give you a deal and charge you $2,000 if you pay for the entire year up front, then maybe you want to do the $2,000 to pay for that entire year up front, and then you don't have to worry about paying for it again until next year when maybe you can do another annual payment. All right, my fourth tip, and this is a smaller tip, but that is to make charitable contributions. Do you remember how the charitable contributions used to be itemized? And basically it was an unlimited deduction that you could use on your tax return. Well, that all changed a couple years ago when the tax laws changed. And even though you could still itemize, there were limits on what you could deduct in terms of charitable contributions. Well, now you can deduct up to $300 even if you don't itemize on your deductions for your taxes. And if you do itemize, you can deduct up to 100% of your adjusted gross income as a cash donation, up from 60% of your adjusted gross income in 2019. All right, so the fifth tip I have for you is to do some tax harvesting. What do I mean by that? What I mean by that is if you hold stock in a non-retirement account, now is the time of year to look and see if you have any unrealized losses on those stock purchases that you made. If you do, you can sell that stock and use the losses to offset your income, including your capital gains. But you have to be aware of what are called wash sale rules. And no, I don't mean washing your car before you sell it. That wouldn't work. If you sell stock, you can't reinvest into the same security for a minimum of 30 days or the loss is going to be disallowed. What I typically do, and back when I worked as a financial advisor, what we recommend our clients do is if you held some sort of stock and then you sold it for the loss, we would reinvest that money into an index fund, and then after 30 days, sell the index fund and buy the stock back. That's how we did it. That's what I'd recommend you do. Hopefully these tips are going to be helpful to you as you start to plan out your end of year tax strategies. I actually did another video that outlines the 5 things that you need to do to legally protect your online business, and you can check that video out right here. Thanks so much for watching, folks, and I look forward to seeing you in the next video. Take care and stay safe. Don't forget to mask up and do your social distancing. You heard it here first. Take care, folks.